Institutions aren't quietly dumping silver because they've become anti-silver. They're exiting because the settlement layer is starting to look like a liability, and liability is what risk desks are paid to remove. Here's the uncomfortable thesis. When a market is built on paper claims, the real breaking point is never the chart. The breaking point is the moment too many people ask the system to prove what the paper actually represents. When that proof is demanded, liquidity becomes conditional and every participant discovers what they were really holding. That moment is called reconciliation. It's when promises get audited by reality, by inventory, by transport, by vault rules, by contract language, by who has priority when everyone wants the same scarce thing. In that audit, the questions are simple. Where is the metal? Who controls it? And what happens if everyone asks at once? Retail traders look at silver and ask, will it go up? Institutions look at silver and ask, what happens if it goes up and delivery fails? That is a completely different game. So imagine a memo that never leaks because it doesn't need to. It's written by the machine itself. And every bank's risk committee independently reaches the same conclusion at the same time. The memo is blunt, reduce exposure to instruments where the worst case is not price loss but settlement disorder. Reduce reliance on counterparties. Reduce positions that become unmanageable in a scramble for physical. That's why the exit is quiet. Loud exits change the market. Quiet exits change the portfolio without waking the crowd. Now you need the mechanism, because this isn't a silver story. It's a systemic story that repeats across centuries, across empires, across currencies, across commodities, across every structure that turns scarcity into claims. If you understand this, you can spot the exit long before it shows up as a trendline break. The mechanism has 4 stages, and the order never changes. Foundation, expansion, stress, reconciliation. Foundation is the anchor of trust. People believe the rules work, the contracts settle, the system will honor the promise when it matters. Expansion is the multiplication of claims. Paper grows faster than supply. Leverage grows faster than resilience. Netting grows faster than deliverability. This is where paper leverage feels like safety, because it masks scarcity behind constant two-way quotes. Stress is the test. Not a headline, not a vibe. An operational test of whether the system can still convert paper into reality under pressure. The stress test is brutal because it hits funding, margins, and delivery timelines at the same time. Reconciliation is the outcome. The system forces alignment between claims and scarcity through repricing, restriction, or redefinition. Systems hate admitting scarcity, so they manage it indirectly until the indirect methods fail. Once you see this pattern, you stop asking whether the price will move. You start asking where the bottleneck is, because bottlenecks decide winners in reconciliation events. History proves the pattern, and history doesn't need your belief. It only needs the same inputs, and the same inputs always produce the same outputs. Start with Spain's silver era. The foundation was imperial credibility, power, and access to metal flows that looked unstoppable. When a system looks unstoppable, lenders compete to lend, and that competition is how fragility scales. Expansion followed because silver inflows expanded borrowing capacity. The Crown and financiers treated future shipments like collateral for present promises. Once the future is pledged, every disruption becomes existential because there is no slack left in the schedule. Stress arrived when wars, disruptions, and fiscal strain created timing mismatches between obligations and inflows. That's when confidence turns into scrutiny. Timing is everything in settlement, and timing failure is how a confident system turns into a desperate one. Reconciliation followed through defaults and restructurings. Not a movie collapse, repeated resets that quietly destroy strategic power over time. Restructuring is simply the paper layer confessing it cannot match the real layer on time. The lesson is brutal. Even real metal doesn't tease. Save you if it becomes the excuse to multiply claims beyond what the system can consistently deliver. Now look at Weimar Germany, where the metal was replaced by paper authority. The foundation was a functioning state, and a currency people were forced to use. That forced usage created short-term stability, but it also hid the decay until people could no longer ignore it. Expansion happened as obligations outran production, and the state bridged reality with issuance. Claims multiplied because reality could not. Stress arrived when people realized the currency was the absorber of every shock. The turning point wasn't inflation, it was the refusal to hold a claim that decays. At that point, the population stops being a consumer of money and becomes a flight mechanism away from money. Reconciliation arrived as a reset, because trust is not negotiable. Once confidence is gone, the unit must be rebuilt or replaced. The reset is the System S way of regaining a unit people will accept without immediately trying to escape it. Now look at Bretton Woods and its end. The foundation was an anchored order, a promise that the rules were stable and conversion was credible. Expansion followed as global trade and dollar liabilities grew far beyond the anchor. Claims multiplied faster than the system could honor its scale. The anchor does not fail because people are immoral. It fails because the math of promises outruns the math of reserves. Stress arrived when holders questioned redemption. The system faced the same question every anchor faces. Can you deliver to everyone, or only to some? Reconciliation came when the promise changed. Convertibility ended. The regime shifted and hard assets repriced as truth meters for credibility. And once the rules bend, every participant learns the hierarchy. Insiders first, latecomers last. These aren't anecdotes, they're demonstrations of the same mechanism. When claims outrun deliverability, the system chooses itself over your expectations. Now apply the pattern to silver today, step by step, with cold precision, because the present is just history running at higher speed. Your advantage is not prediction, it is recognizing the stage before the crowd changes behavior. Foundation. Silver is traded inside a settlement network. Futures, forwards, swaps, ETFs, custodians, unallocated accounts, clearing, and netting. The settlement network is powerful precisely because it can create exposure at scale without moving heavy metal every day. That network works most days, which is why people confuse works in calm with works in stress. Those are not the same thing. Expansion. Paper exposure can be created far faster than physical silver can be mined, refined, and delivered. That's not a theory, it's how paper markets function. This is why the paper layer can grow for years without issue and then crack in weeks when behavior flips. Netting and rolling reduce the need for delivery, which is efficient, until a larger than normal group decides they want metal instead of exposure. The exit hatch exists, but it is not designed for a stampede, and stress is when stampedes happen. Stress, higher funding costs, geopolitical risk, supply chain friction, and industrial demand create the conditions for a deliverability test. The trigger can be slow tightening, or it can be one sudden event that forces everyone to reassess counterparty risk. This is where institutions stop asking price target and start asking tail risk. Tail risk is not volatility. Tail risk is rule change. Check. When the system is stressed, the market shifts from price discovery to delivery discovery. Premiums matter. Logistics matter. Vault categories matter. Timelines matter. Even small distortions are signals, because in mature markets, distortions only appear when constraints bind. Verified. And once timelines matter, the value of an instrument is not its ticker. The value is its legal pathway to physical control when the system is tight. In crises, lawyers matter more than analysts because contract language decides who gets reality, undeniable. This is why institutions dump silver in ways that look bearish on the surface but are defensive underneath. They're reducing exposure to paper promises, not rejecting the metal. That is why bearish can be a mask for reduced tail risk exposure before the system gates you. The paradox is important. The fear is not only downside. The fear is upside under broken settlement, because upside forces delivery pressure, and delivery pressure forces rule pressure. In other words, a sharp rally is not just a profit opportunity. In a strained system, it is a stress event that triggers policy behavior. That's why they shorten duration. That's why they reduce leverage. That's why they reduce gross exposure. That's why they demand optionality. Optionality means you can exit without begging for liquidity, and you can hold without depending on a counterparty's goodwill. Silver is uniquely sensitive because it's both monetary psychology and industrial necessity. It's not only stored, it's consumed. Consumption changes everything. A speculator can helpfully sell. An industrial buyer must secure supply, even if price is ugly. When supply chains tighten, the industrial bid becomes less price sensitive, and that bid stresses the whole structure. When procurement demand increases, it doesn't behave like a trade. It behaves like insurance. It locks in and removes float. That is how shortages form in settlement systems. Not from headlines, but from small shifts in behavior that tighten reality against a large paper layer. Now picture the system's response options in reconciliation. Option 1 is repricing. The market moves violently to ration demand and discourage marginal buyers. Option 2 is restriction. Access changes. Margin rules tighten. Limits appear. Certain products become scarce or delayed. Option 3 is redefinition. Delivery becomes cash equivalent, substitution becomes standard practice, and delays become temporary measures. None of those options require evil. They require survival. Systems always choose survival, and intermediaries always choose the rules that protect intermediaries. That is why the language is always calming. Stability, orderly markets, temporary measures, enhanced resilience. So what does the memo say in plain language? Don't be holding someone else's promise when the system demands proof. Because in a world saturated with claims, collateral quality becomes sacred. The more debt and leverage the system carries, the more it worships deliverability. Deliverability becomes the hidden benchmark, and instruments that depend on trust get marked down in real time. That's why this is bigger than silver. Silver is a mirror reflecting a broader shift, from abundance psychology to scarcity governance. Scarcity governance means the market can move from how much to whether. Not what price, but can you access it at all? If you've never lived through an access crisis, it sounds dramatic. If you have, it sounds inevitable. In calm times, the public debates direction. In stressed times, institutions debate settlement terms. And in reconciliation, the debate ends. The system decides, and everyone else receives the decision as policy and market conditions. Now, the actionable takeaway is simple, but it's not easy. Audit your exposure like an engineer, not like a gambler. Ask what exactly you own. Is it metal you control, or a claim on metal controlled by someone else? Ask what your instrument promises under stress, not under marketing. Read the language that starts with "in exceptional circumstances." Ask what happens if liquidity disappears. Ask what happens if redemption windows tighten. Ask what happens if rules change mid-game. These questions sound boring until the day they become your entire financial reality. If you cannot answer those questions, you don't have an investment thesis. You have a hope. Hope is not a strategy during reconciliation events, because reconciliation events punish assumptions and reward clarity. Reconciliation events are where confidence gets repriced, and confidence is the largest position most people don't know they hold. Now address the most common denial. This time is different. People say that because it's comforting, not because it's true. Technology makes markets faster. It does not remove scarcity. Faster systems snap harder when the bottleneck is physical. Advanced finance often means more layers of intermediation. More layers create more points of failure when trust weakens. More layers also mean more legal pathways for deflection, delays, and reinterpretation when pressure rises. Risk models do not eliminate stress. They front-run it. That's why institutional exits look early and quiet, which means the most dangerous phase is not the panic. The most dangerous phase is the calm repositioning before the public understands the risk. That's where we are. The exit is happening in portfolio construction, not in headlines. Watch what institutions do, not what they say. They will not announce delivery risk. They will simply price it into behavior. And that behavior looks like dumping. Until you realize it, it's rotation. Away from exposure that depends on trust, toward exposure that depends on control. Rotation looks boring, but it's the most important signal you can watch in a tightening system. Control is the real asset in stage 3 and stage 4. Not the narrative, not the chart, not the influencer certainty. Now, let's close the loop. The pattern is absolute. Foundation creates trust, expansion multiplies claims, stress tests, deliverability, reconciliation forces alignment. Silver is flashing because it sits at the collision point of money psychology and industrial necessity inside a paper claim machine. And when those collide, the system doesn't correct politely. It redefines reality through price, policy, or both. So here's the final warning. Don't wait for permission to understand the machine. Permission comes after the rules are written. If you want to survive, you position yourself with clarity before the crowd learns what settlement risk means the hard way. Because the people who get hurt are not always the people who are wrong about direction. They are the people who were wrong about what they owned. Direction can be right and still lose you money if your instrument fails at the critical moment. And if you want the next step, it's not what's the price target. It's how the paper engine was built, where the bottleneck hides, and what triggers rule changes. Price targets are entertainment. Plumbing is survival knowledge in a reconciliation cycle. Subscribe, because the next video maps the plumbing. Who clears, who guarantees, what breaks first, and what happens when the system chooses itself. If you know the first weak link, you can predict the next rule change before it's announced. This is not about predicting a candle. It's about understanding the machine that prints claims and then, eventually, demands proof. Candles are the shadow on the wall. The machinery is what casts the shadow. Foundation, expansion, stress, reconciliation. Once you can name the stage, you can choose your response instead of copying the crowd. See the pattern early, and you don't need luck later. That is how you turn urgency into strategy, and strategy into survival.